Well, good morning, everyone, and thank you for joining us this morning for the Federal Reserve Open Market Committee recap. I'd like to introduce this morning our economist, David Widmar, co-founder and managing partner of Agricultural Economic Insights. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. And so any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. So as we get started this morning, and as David comes online here, I just want to call out that this is a new program that we are excited to be offering this year. And so at the end of today, we're going to be having a survey pop up when you close that webinar screen. And so we'd love for you to be able to provide your feedback and make sure that this is kind of hitting the mark. The purpose of this, when David and I were kind of thinking through, was that there's a lot of information out on the market. But are you truly understanding the impact that it has at the farm gate? And so David has committed to being able to go through, review what the Fed said yesterday and bring it to the farm in hopefully a pretty meaningful way to you and your operation. And so with that, David, we're right at the 9:30 mark, so I'll kick it over to you and we'll get started, my friend.
Well, thank you so much, Mike, and thank you all for joining this morning or following up in the recap that was recorded and emailed back out to everyone. And as Mike has said, this is our first version of this, so we appreciate your comments and your feedback. But the idea here is to step back and say, hey, what was the Fed's latest commentary around interest rates and the economy? How does it fit in the context of broader trends? And what does it mean for my operation and for my farm and for the decisions that I'm going to make in the years and months coming up? And to get started here, I want to set the stage here. And Jay Powell did a really good job of this in his discussion. It's just a little bit of a recap here. What happened is the Fed had a 2-day meeting with a whole bunch of economists, and Jay Powell leads that meeting, and then he proceeds to have about an hour press conference. And after the results get announced, so a lot of the insights try to get captured in that press conference, which I think would be quite a hair puller when you think about all these reporters after a 2-day meeting, and then having all these reporters trying to get you to shed a little more insight without tipping your hand too much. And so it's a give and take. But one of the things he shared in that press conference was that they have two-sided risks that they're facing. The risks are two-sided in that if they cut rates too soon, they risk inflation roaring back. And if they cut interest rates too late, they risk unnecessary harm to employment. And so this is this rock and a hard spot that the Fed's going to be navigating here in the next several months in 2024. And we're going to see what happens and we're going to see what they're going to do. But the top line estimate here is no change in the Fed funds rate at this meeting, but they still expect, the consensus is for still 3 rate cuts to happen in 2024. So let's get started here, and I want to share some data that comes out of the Federal Reserve meeting. These are data that comes out of their meeting just this month. So 4 times a year, they release their internal projections. And this is sort of a survey that gets circulated, and it's the FOMC board members and the Federal Reserve presidents. They're sharing what their expectations are for various economic measures, from GDP to unemployment and inflation and the Fed funds rates, and this is summarized and this is distributed. Now, there's a lot of ways you can look at this data. I think the one that's really, really powerful is thinking about this as going back to high school, grading on a curve. This is sort of the curve, the baseline of how the Federal Reserve is going to be grading the U.S. economy in the coming months. If the economy does better than what this baseline is, the Fed's going to adjust their response to the interest rates accordingly. If the economy comes in below this threshold, we're going to see them pull around. So what were those assumptions? What's that baseline? What's the curve that led them to think they're going to move 3 times here in 2024? Well, the first one is changes in real or inflation adjusted GDP. The top line are these March expectations. So they expected real GDP in 2024 to be up 2.1%. And then the line below it says what their expectations were just 3 months ago. So 1.4% back in December. So you can see they had a pretty big uptick in the overall expectations of the U.S. economy here in 2024. And in fact, that spills over into 2025 a bit as well. Now let's move to the next one. unemployment rates. Unemployment rates, we're going to talk about this in a future graph, dive into this a little more, but it's at 4% is their expectation. And the projection just 3 months ago or at the last quarterly meeting was 4.1%. So a little better outlook here for unemployment as well. And finally, PCE inflation is unchanged at 2.4% expectations for 2024. And then again, they see this tapering, this return back to that long run goal of 2%. So I mentioned, I think the best way to use this data is thinking about this grading on the curve or understanding how they're going to maybe deviate from those initial plans of, again, 3 rate cuts here in 2024. I think oftentimes it's tempting to look at this and say, oh, the Federal Reserve folks think this, and then we're going to score their answers at the end. We're going to see how good of a forecaster or a prognosticator they are, and we're going to show that they're not as accurate as maybe we want them to be or hope them to be. I don't think that's the right way to use this. I think this is a really important tool, really helpful tool that they put out there, and it really helps us understand, again, the baseline that they're using and how they reach those conclusions. So if we see additional information or we disagree with them on some key element here, we can start to kind of build our own expectations and the deviations from that. But again, the 3 top categories, GDP, unemployment, inflation, these all trended favorably, especially when it comes to economic growth. So if we jump down here, we see that what we have is for the Fed funds rates, the median, again, these are the median expectations, 4.6% for that FOMC rate, and again, that was 4.6% back in December. So that's how we get to these 3 rate cuts. And I should put a little asterisk here as we're talking about this today. I'm going to use the descriptor of 3 rate cuts. The idea here is about 75 basis points. And I think one of the challenges is if we say 3 rate cuts, it's assuming 3 75 basis point cuts to get to 75 basis points. One of the shortcomings to that is we start to connect dots and we say, oh, they're going to announce 3 times that they're going to cut 25 basis points. This could happen in 1 cut or 2 cut or 3 cuts. But the idea here is that 3 cut is sort of 3 25 basis point movements. But again, it could be divvied up in a different manner. One of the, I guess, not so optimistic news is if you're hoping for lower interest rates is if we look at 2025 and 2026, we start to see the Fed funds expectations actually increase a little bit for what those rates might be a year or 2 from now. So let's think about this. Back in December, they thought that in 2025, the Fed funds rates were going to be around 3.6%. They moved that up about 25 basis points to 3.9%. And of course, if we look out to 2026, a similar uptick here. Again, the idea here is still trending lower. The trend across all these is lower, but maybe not as fast, especially as we move out. So the same pace in 2024, but not as rapidly as we start moving out to 25 and beyond. The other observation here that I want to point out is a lot of different ways you can summarize this data. And so this was the median. Again, the median is the sort of the middle of the pack. So we line all the forecasts up from highest to lowest and which one was in the middle. Now the range here is going to capture the highest observation and the lowest observation from there's about 19 participants who shared their expectations here. And what I want to point out here is if we move on the Fed funds rate all the way over to 2024, you can see that the high end expectation stayed at 5.4%, unchanged from December. But we did see that low end move up a little bit. So at the lowest forecast or the lowest expectation back in December was 3.9%, and that's moved up to 4.4%. So we'll dive in that just a little bit more here in a little bit. But again, we saw some of the downside movements of interest rates coming off the table just a little bit from maybe just 3 months ago. But again, the median is unchanged at those 3 basis points movements. Now, this dot plot is my next chart here. And I think this is going to help you think a little bit about that range versus the median, how that lower end, those lower end forecasts moved up. So the dot plot is every individual forecast, and there's about 19 of them out there, and we've plotted them, or the Federal Reserve plots them, so you can see where those main expectations are. So for 2024, there are 4 participants who think that those rates are going to stay above 5%, and the remaining participants think it's going to fall below 4%. And so we talked about this earlier. There are a few participants back in December who had those rates even lower, falling close or below that 4% threshold, and those folks have moved their dots up a little bit higher. So that median is still unchanged, 3 rate cuts, but that downside tail has moved closer to the middle of the pack, closer to the median. But still, there's about 125 basis points of gap or of range in expectations for 2024. So oftentimes we hear the Fed summaries and Jay Powell says we still think that there's 3 rate cuts in hand. I showed you that table from earlier. Oh yeah, 3 rate cuts. But even amongst the 19 participants in this room, there's a big range of expectations, 125 basis points of expectations for the Fed funds rates. And if we move out to 2025, there's even a bigger range of expectations, a bigger range. So there's 4 participants that think rates are going to stay above 4%. One of them thinks it's going to stay above 5% for quite a while. So you can start to see how much uncertainty the Federal Reserve participants think. I think this is a really helpful tool. It helps us maybe not get so locked into those summaries. It helps us think about the range of possible outcomes. So when we're thinking about the decisions we're making, and if we agree or disagree with the Fed, well, there's some consensus. We see the consensus summaries out of the Fed, but at the individual level, there's a wide range of expectations as we think about. So in general, everyone sees this trend lower, or most folks see this trend lower. It's just a question of how quickly and how soon that starts to play out. I want to shift gears here and talk a little bit about inflation. Inflation has been in the headlines quite a bit over the last several weeks when we saw some data that pointed that inflation was maybe hotter than what the market was expecting. So we want to talk a little bit about that and talk about what we can learn and how we can think about that a little bit differently. So PCE is the Fed's quote unquote preferred measure of inflation. And so keep in mind these inflation measures typically come from price index. And so what I've done here is January is the most current data for PCE. We're gonna get some data later this month talking about February. In general, PCE is a little bit lagged compared to CPI or PPP. And so, or PPI. And so what we need to think about here is let's talk about this index. And so as you can see, I have the January data plotted over here. So you can see how fast this index increased back in 2020 versus 2021. This is whenever we started seeing inflation get concerning. There wasn't a whole lot of change from January to January, so January 2020 to January 2021, but there was a big gap by the time we got to December, and we saw big increases into 2022 and 2023, but now we start to see the lines between 2023 and 2024 narrow in. That's a reflection. This is what we're capturing and measuring when we talk about inflation is slowing. So this is, again, a different way to visualize this, but I think it's important to reflect back to this index. But most of the time we see inflation reported on as a change from a year ago or a year-over-year change in inflation. And as we can see, we got this PCE measure up above 7% back in this height of the concern. And then, of course, it turned lower and it's turned sharply lower. And we're seeing data coming in at or below this 2.5% level, which is optimistic for the Fed. It's giving them this cover to start maybe lowering rates. They're starting to prepare for inflation. They want to start to ease the interest rate story before inflation gets to 2%. They don't want to overdo it. That's that two-sided risk we talked about earlier. So we're starting to see, that's why this conversation has started to shift. Of course, if you've heard me talk about inflation before, you know I like to include a long data series because inflation in the last 2 or 3 years has both been higher than anything we've seen in several decades, but it's also nowhere near what we saw during the 1970s, during that period. And so we had about a decade's worth of inflation that was at or higher than the levels we saw back in 2022. So much different story. I think the 1970s also speaks to that concern that Jay Powell talked about earlier. If they ease up on the interest rates too soon, they risk inflation coming roaring back like we saw in the late 70s. And this is when Paul Volcker came in. This is when we had the big interest rate hikes to really get it under control. So this is the inflation story. The Fed still has expectations of an average here at 2.4% for 2024. Now, there's a couple ways of even measuring this, and I want to give you an example here, but this is year over year changes. So it's a year over year. We're looking at this dot compared to this dot. And back here, we're measuring this dot versus that dot. We're lining this up year over year. Now, I had to give this example here, and it's sort of a hypothetical of a different way we can look at inflation to maybe give us a little better understanding what's going on in the economy. This is a hypothetical actual reported price, and I said it was $1,000, and all of a sudden in January, so all of 2023, the price of this widget was $1,000, and in January 2024, they raised the price to $1,100, and of course the price in this example stayed flat. It was a one-time price increase, and I like to use the example that maybe it's like a new cell phone, okay? And so if we were using the year over a year measure that I talked about earlier with those indices, sort of what was the value index value today, what was it a year ago, we're going to have a year of data that comes out that says the yearly year over year change was 10%, because even in September we had $1,100 widgets, and last September they were $1,100 widgets, and so we're going to have 12 months of 10% inflation, 10% inflation, 10% inflation. Now, that's helpful in one respect because we understand what 10% over a year ago really means. It's a very quantifiable number, but it kind of over exaggerates these sudden spikes in prices. And so if we used a month over month look at inflation, so we did month versus month, and we look at this for this 2024, we're going to see these prices, blipped up one time and then they fell back down. So why am I talking about this hypothetical example? Because I'm going to show you another measure to look at inflation that you sometimes see in the press, and I think it's important to mention, is this is the PCE inflation measure, not year over year, but change from the month before. And this is why we're starting to see a little bit of concern in January and into February about inflation roaring back to life potentially, because we had, I think this is January, December, November, October. The PCE measure had very, very low month over month changes as we were in the last quarter of 2023. And now in January, and we saw this replicated in the CPI measures, we saw these monthly measures spike a little bit higher. So why were we talking about this monthly measure? Well, if we're going to continue to monitor this, we want to see what these monthly measures look like for the rest of Q1 and into Q2 for 2024. But also keep in mind, these are these blips, ups and downs, this fits and starts that Jay Powell has been talking about. It's a bumpy road. It's not a linear return to 2%. We're going to have these spikes, these flare-ups and down. What's important to also note is that we had similar flare-ups late in 2022, and this is what it looked like when inflation was really roaring back to that 7% annual change. This is what it looks like. Of course, the downside to month-over-month changes in inflation is it's really hard to wrap our mind around what a 1% change or a 0.75% month-over-month change means. It's kind of an abstract number, and you got to do a lot of math to get it to an annualized basis. But again, the takeaway here is that inflation has been trending very, very favorably. The Fed thinks that's going to continue to play out. We saw a bit of an uptick, not overly concerning, but if it were to stay at these levels or even increase, we might have to see the Fed back away from these 3 rate cuts that are planned. But we'll keep an eye on this. We'll keep this updated. But this is the concern that you've seen most folks talk about, is this month-over-month change. All right, I got a couple more slides for you, and then we're going to answer all the questions that you've been submitting along the way, so make sure you get those put in. If you heard me speak this winter at all, I apologize. This is kind of my soapbox the last few years, but I think it's really, really important for producers at the farm level. This is a look at short-term versus long-term interest rates. In blue are the 10-year treasuries. In red is the interest rate on a 1-year treasury. And the idea here is, in general, we expect long-dated money to have a higher interest rate than short-dated money. And that hasn't been the case for about the last year. You can see where these short-term loans, this 1-year loan, has had a premium over these long-dated loans. And of course, sometimes people look at this and they correlate this to the recession, and I don't want to discount that or talk about that here today's, but I want to talk about what this means for you as a borrower as you think about, how am I going to go out and be using farm debt to grow my business, and what kind of debt should I be using? And when we look at this trend and this data, we're in a period, and we've been in a period for a while now, where short-dated money has been at a premium to some of these longer-dated loans, these long maturity loans. Of course, this is, again, 30,000-foot data. These are government bonds, but we're going to see this trend play out. The magnitudes might be a little differently, but the general trend has been playing out for the farm loans that you're using for your operation. I took that data and I looked at it a few different ways. The chart on the left here, this is that spread between those 10 years and the 1-year treasuries. And as you can see, in general, I've plotted over here, the average spread is almost 1 percentage point, which means that if you want to borrow money at 10 years versus 1 year, again, or you're going to buy these 10-year treasuries versus 1-year treasuries, you can expect on average about 1 percentage point difference. It's going to vary for the farm loans that you're going to be taking out, but as you can see, there's a lot of, the average is 1, but we spend very little time at 1%. But as you can see here, we've had this prolonged period where we've been well below average, and we've been well below in this negative territory, this yield curve inversion territory. And the last time we saw yield curves this inverted for this long was, of course, in the 1970s and early 1980s. So this is, again, another history rhyming example. The chart on the right sort of lines up all those observations from most negative to most positive, and the horizontal black line is that long run average, right below 1%. And here I plotted the current situation where we are today, which is at negative 0.75 or so. We've been there for about the last 3 months for on average. And you can see we're in about the 7th percentile of observations. So if you think about since the 1960s, we've only been at these levels or lower about 7% of the time. In fact, about half your career, this spread is 1 or greater. So when we think about this and the implications for your operations, really start thinking about the types of debt that you want to be using, this year or down the road. We might see some opportunities or some advantages of using looking at machinery loans more so than operating lines of credit. Again, work with your financial officer to think about these specific implications and think about the consequences and the trade-offs for your operations. But this is sort of another market trend that's really playing out that could have implications for your farm. So I'm going to wrap it up here. The economic outlook continues to be improved. That's a good sign across all sectors that we talked about. GDP, unemployment, and inflation all trending favorably. The 3 rate cuts or 75 basis points are still in the cards. They're still on deck. I think key to monitor here, if you're looking for canaries in the coal mine, inflation and unemployment. I think these are the 2 data points that we get regular updates on, about monthly. It's pretty timely updates. And these are the ones where the Fed's going to have to really maybe adjust their position. These are the data points that are going to be the toughest questions for the Fed to have to navigate if they start to deviate from those benchmark projections. Key unknowns that we're going to keep monitoring in this series throughout this year. Again, we're going to revisit after on a quarterly basis here, those Fed meetings, not all the meetings, but 4 of them throughout the year. The key unknowns we want to keep an eye on is where do long-term rates go? We talked about that. How does that inverted yield curve begin to uninvert? Why I'm talking about this is that even if the Fed does lower those 75 basis points here in 2024, are long-term rates going to follow it lower, or are they going to be sticky, or could they drift higher as that yield curve might uninvert itself? So we got to keep an eye on long-term rates. There might not be as much downside for long-term rates when we think about 2024 and beyond. And my last point I want to talk about, and I expect we're going to talk about this in an upcoming conversation, is the Fed's other tool. Being hyper-focused on the funds rates, but they have another tool. It's the balance sheet. They were buying assets, buying bonds during the pandemic and after to stimulate the economy. They have been shrinking the balance sheet or selling bonds in the last several months to also put the brakes on inflation and keep things cool. But there hasn't been a clear path of what their plan is for shrinking or pausing the shrink of the balance sheet. There was an interesting exchange that actually happened during that review. Can really economic focused reporters and Jay Powell kind of in one room. It's going to be an interesting conversation. And Jay Powell said it's appropriate to slow the pace of runoff fairly soon. And so he's talking about the runoff of the balance sheet, the shrinking of the balance sheet. It's appropriate to slow that pace at some time fairly soon. So they kept asking him what that meant, what the timeline meant, and he just says, by fairly soon, I mean fairly soon. He was not going to get pinned down on a specific point here, but we're going to keep watching long-term rates and that balance sheet runoff. So At this point, I'm wrapped up. I'm happy to answer any and all questions that you might have. So Micah, appreciate your help here navigating the questions.
Yeah, we have quite a few for you, David. So I'm going to start off with an interesting one here. A customer asked about a lot of the media was talking about a soft landing. Was there any indication within that meeting that referenced that they were happy with the quote unquote soft landing that's been referenced, for going on 2 or 3 quarters at this point?
I think, it's still been favorable, good news. I think the idea here of a hard landing versus a soft landing, the question is how can you get inflation back down to 2%? Can you do that without creating a lot of economic upheaval? Can you generate it without a massive recession or a prolonged recession, especially when it comes to the unemployment? A year ago, we were talking about unemployment rates quite a bit. The idea here is how much unemployment are we going to have to see come into the economy to get inflation down? So far, yes, positive story. I've been surprised a little bit by this, and I think the good news is it's made the Fed's job a lot easier. They've been able to raise rates, bring inflation down, and we haven't seen the economy go off the rails. We haven't seen unemployment rates surge higher.
Is inflation beneficial to the government handling their debt? And is that part of this overall story right now?
Well, there is a trade-off. There are trade-offs and consequences. And when we had really, really low inflation between, let's say, 2010 and 2017 or 18, the Federal Reserve was concerned about it, and they were trying to get more inflation into the economy. And so I think kind of like Goldilocks is what's the appropriate level of inflation. And one of the benefits for the federal government is we have sort of a fixed amount of federal debt out there that we need to be servicing. And if we can increase the size of the economy, if we increase the size of tax revenues that the federal government can collect at a faster pace, at 2.5% instead of 1.5%, that makes their budget scoring a lot easier. And so the idea here is we use 2%, but I think it's a good question of is 2.5% sufficient, or is 2.0% the actual number, and do we risk going back below 2%? So there is a trade-off, and that's a little bit to the point of why the Fed is an independent body, not really it's not a congressional decision as to where inflation targets are or where unemployment targets are.
Another question that came in was the likely impact of presidential election on the economic path and interest rates.
Yeah, that's a great question. Keep in mind, Jay Powell was appointed by President Trump in 2017. He was also, Trump was going to fire him back in 2019 when the Fed was shrinking the balance sheet before the pandemic in 2018 and 2019. There was, stop the 50 Bs and the tweets saying, he was going to fire Jay Powell. The Fed's going to want to look as avoid stepping in the middle of the election as much as possible. DC's had this sort of mantra of it's election year, we can't do fill in the blank. And so I think what we're seeing is the Fed was signaling all the way back in December that they're going to have 3 rate cuts. They haven't deviated from that. I do think what we're probably going to see in the next 3 months is probably that plan for the balance sheet's going to get out there and published, and we might see the Fed lower rates a little bit faster. That's why I was distinguishing between 75 basis points and 3 rate cuts. We could see them make bigger steps sooner to try to get out in front of that election. But then also they have the opportunity after the election at that December meeting to make rate cuts as well. So there's probably going to be a period where they try to avoid, but at the end of the day, the Fed's going to do what they need to do to get the economy on track and keeping people employed.
This next question is something that you've already kind of alluded to, but I want to give you a chance to readdress it. Any concern inflation worry reappears in the latter half of 2024?
I think that's a really important concern. I think it's a concern, in my opinion, probably into 2025, maybe even into 2026. There's a little bit of a psychology element to this. There's this kind of casual saying, or inflation's too much money chasing too few goods. And a lot of times we try to quantify how much money is chasing how many goods. But I think the psychology of it is that word chase. When do people decide they want to chase things? And the Federal Reserve couldn't get inflation hotter between 2010 and 2016, 17 when they were trying during quantitative easing after the Great Recession. And now we have the other side of this is there's a lot of chase going on. So we're trying to cool down the money supply, but does that actually end the chase? Again, it's psychology. We'll see how this plays out, but I do think that could be a risk that we see for the next few years.
A couple of folks on the call are very interested in U.S. exports and what that means for agriculture. So they suggested, does the strong dollar policy affect the U.S. export industry?
Yeah, when we see the dollar make big changes, either stronger or weaker, so stronger and weaker, that's a common phrase, but I think it's not necessarily always the right way to do it. Generally speaking, strong means expensive, weak means cheap. So an expensive dollar, a strong dollar means our trade partners need more local currency to buy US dollars before they can buy our commodities. And so when we see a strong dollar relative to the rest of the world's currencies, it starts to be a bit of a headwind as producers in South America or parts of Europe or Asia can export their goods at a little more competitive frame point. We don't necessarily think about it as much at our individual business level, but again, keep in mind, it's foreign buyers have to buy US dollars before they buy US goods.
And then just one last one for you on the flip side of that. Is there, any probability, or do you have any predictions on the dollar going lower in the near future?
Well, I mean, that's always a possibility. It's a really great point. There are some good, and we'll talk about this in one of these future episodes. And there are some arguments out there about why the economy is going to need to have low interest rates and why we're going to struggle with a strong dollar. We're going to have a strong dollar for quite a while, and one of it's because there's a list of arguments why we can see rates go lower and we can see the dollar stay strong. And then there's another set of arguments about why we're going to see high interest rates for a long period of time, and we could see some dollar weakening happening. And one of the big arguments in that camp is sustained government spending. We have federal debt at historically high levels, and we've just seen a whole lot of spending happening in the last few years, but also the last 3 or 4 decades. There's been kind of the only thing Congress can agree to do most of the time is to spend money. And so we'll have to see how that comes together. We'll have to see how that pulls out. But yes, a weak dollar could come into play if there starts to be concern about the amount of debt that the U.S. government is maintaining and how we're going to go about sourcing that debt.
Well, thank you all. We're about 2 minutes over, but so many good questions and thoughts coming in. So I do appreciate you all registering and joining us for this. Like David and I said, this is the first attempt at hopefully bringing you some value around this topic, and a difficult topic indeed, right? A lot of moving parts. And so we're committed to doing 3 more of these throughout the year, quarterly, so that we can bring you some insights and updates as to what's going on. And I think, David, after doing this recap, we'll be able to compare some of these notes the next time that we join together. So stay on top of our social media, watch for those invitations to join, register, and we can't wait to see you next time. Thank you all. And this will be recorded and available on the website. So if you have any questions or want to rewatch any of these insights, please feel free to go to fcma.com. Thank you all so very much.